Wouldn't a sale or merger transaction this year mean I'd be conducting a fire sale, you may wonder? Not necessarily at all. But I would offer caution about the calls that you may be getting from companies that are fishing for bargains. If your company was strong before COVID-19, acquirers, lenders, or investors will certainly take that into account. If you've done what you can to strengthen the balance sheet, explored scenarios, and created contingency plans to build resiliency, that'll help tremendously. And by all means, you want to be professionally represented from the very beginning. Neither seller nor buyer will enter into a transaction that they feel is adverse to their interests, but most generally will if they think that it's fair to both parties. Well, in this case, both parties do share the same uncertainty. It's like the meteor that fell from the sky that we now all have to work around. The uncertainties can be addressed in deal making and transaction structuring that's sensitive to the uncertainties, yet avoids the seller from having to give away the company to do an M&A or capital transaction. If it's one thing this COVID-19 crisis has really underscored, it's the very limited utility of historic financial statements. Even before COVID, they were really only very useful as a reasonability check against pro forma future forecasts. Since acquirers or investors always buy only future earnings, never historic, a way to address the uncertainty is to create probability-weighted revenue and cost structure scenarios that both parties can agree on. If you have recurring revenue, focus on your retention rate since February and the aggregate effect on lifetime value of your customer base. If we're your investment bank representing you, I'll certainly work with you on all of this. A frequently used, but certainly not the only mechanism is the earnout, which is a contingent payment mechanism based upon future defined conditions. 20% of middle market tech transactions that were not life science, that were $100 million and under, which closed over the past 3 years, had an earnout mechanism tied to it. Conversely, of those that did have an earnout, 62% of them also had a mechanism in it that said the buyer can offset indemnity claims against future earnout payments. So if something adverse to the buyer or investor occurs, as described in the purchase agreement, they can hold back some of the money that they otherwise would have paid out in the earnout. This is just a small glimpse into the horse trading that's done to get any deal across the finish line in an adverse market like this or any market. If you'd like to have a discussion, please give me a call at area code 415-294-0002 or email me at mdb@mmsib.com. If you feel that these short discussions are worthwhile, please consider subscribing to my YouTube channel by clicking the red subscribe button below. Thanks.